Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. Now we're talking about market organization and structure. Key two topics here, we're going to talk about orders and how we actually execute trades on an exchange. And in order to do so, we're going to need to know some information about bid-ask spreads, or the prices that investors are willing to buy at versus the prices that investors are willing to sell at. We'll also be talking about the use of margin and how that impacts the leverage ratio that one can use in a trade, and implications that it has around margin call price, and maintenance margin. From there, we'll be giving some examples of an investor that has some belief or hypothesis about what a stock price is going to do, whether go up or down. And we'll be asked to apply some instructions on how to execute this trade and when to execute this trade. So key things we're gonna have to think about are: one, execution instructions, which are primarily related to price, and then validity instructions, which are mainly related to when the trade can actually execute. So like at market open, at market close, good till canceled, stuff like that. We'll get into it, and then we'll also be discussing order types. So like you have like market orders, which takes the prices given. You have limit orders, stop losses. So we'll discuss when these are all useful and when they make the most sense to implement. And then from there, we're going to be talking about the primary markets and how companies can raise capital from investors through IPOs, which we're already familiar with, private placements, rights offerings, and shelf registrations. Really quickly, a private placement is essentially a sale of capital to a bunch of qualified investors who aren't necessarily shareholders right now. A rights offering gives existing shareholders the right to purchase additional capital from from the company in proportion to their current equity ownership, so no one gets diluted. And then a shelf registration is essentially when a company makes the regulatory filing saying that they want to raise capital and essentially pre-approves it, but then they only raise the actual capital when the market conditions are favorable for them. So we'll jump into these and clear these up as well. Really quickly, the learning module also talks about, or introduces, some concepts around derivatives and forwards and stuff like that. I'm not going to cover it here. I think that it makes more sense logically just to wait to the derivative section and go into those in more detail. I don't want to kind of clutter this video with some derivative stuff. Um, so yeah, that's going to be my approach. I think it makes more sense. And they also have some additional info on secondary markets in the learning module, which is, when investors are selling amongst each other, and the different types of secondary markets that exist. From my experience, not very popular on exam day. So once again, not going to confuse anyone or divert our focus to that, but just one of those things that I would encourage reading some definitions in the notes about, just so you're somewhat familiar with it. But like I said, really don't see this on exam day from what I've seen. So with that, let's just jump right into the questions. A friend has asked you to explain the differences between open-end and closed-end funds. So this is usually referring to mutual funds. Which of the following will you most likely include in your explanation? Closed-end funds are unavailable to new investors. No, that's not true. Closed-end funds trade on secondary markets, so they trade on like an exchange, and investors can buy and sell these funds amongst themselves. For B, when investors sell the shares of an open-end fund, they receive a discount or premium to the fund's net asset value. No. So an open-end fund basically takes money um, at inception of the fund, and whenever anyone buys or sells their shares, they're trading directly with the fund. And due to this, the fund's price rarely changes from its net asset value, which essentially is, the weighted average of the shares outstanding to its holdings. Um, in contrast to this, a closed-end fund, like I said, trades in the secondary market, so it might be not equal to its technical net asset value. And this is mainly due to, the regular functions of the stock market, like demand might be greater than supply or supply less than demand, or everyone's just like running away from equities because bonds are yielding more. So the open-end fund, given that you're trading with the actual fund itself when you buy and sell, will pretty much always be at net asset value, but the closed-end funds in the secondary market might not be equal to net asset value. So that's wrong as well. Our answer is going to be C, but we can read through it. When selling shares, investors in an open-end fund sell shares back to the fund, whereas investors in a closed-end fund sell the shares to others in the secondary market. Yeah, so we already covered this, so that's our answer. An online brokerage firm has set the minimum margin requirement at 55%. What is the maximum leverage ratio associated with the position financed with this margin requirement? So brokerage firms, or your typical stock trading platform that you use, has a margin requirement of 55%. So the leverage ratio you could use is calculated as 100%, which is your position, divided by 55% equity, which is your margin requirement. So you need to maintain 55% of your position as equity. So if you do 100% divided by 55%, you get a leverage ratio of 1.82, which is your answer, B. Traders purchased 200 shares of a non-dividend paying firm on margin at a price of $50 per share. Leverage ratio is 2.5. 6 months later, the trader sells the shares at $60 per share. Ignoring the interest paid on the borrowed amount and the transaction costs, what was the return to the trader during the 6-month period? Well, first we can just calculate the return on the actual change in the share price. So that's going to be 60 over 50 minus 1, which is 0.2, so 20%. But we have 2.5 times leverage, so that's going to magnify our returns. So 2.5 times the 20% we just calculated is 50%. So our answer is C, our return is 50%. So you can see how leverage increases our return versus, just buying with all equity. Caroline Rogers believes that the price of Gamma Corp stock will go down in the near future. She has decided to sell 200 shares short at the current market price of 47, and we have an initial margin requirement of 40%. Which of the following is an appropriate statement regarding the margin requirement that Rogers is subject to on the short sale? So here we have some values for the margin, so we can actually just calculate it ourselves and see which one's right. So 200 shares short times the price of 47 gets you a total value of the position of 9,400 and 40% margin requirement. So we can multiply this by 40%. And the margin we have to contribute is 37.60. So our answer is going to be A. This one's wrong. This is the wrong value. And we can look at C as well. She will only need to leave the proceeds from the short sale as deposit and does not need to contribute any additional funds. No, this isn't true. So really quickly, so the way a short sale works is there's been some confusion historically in terms of how these short sales work. So one, you decide to sell short, right? And then basically what happens is someone lends you the shares and then you sell them in the open market. Right? So then here you actually get proceeds from selling the shares. So she's going to get this amount here, right? And then at some point in the future, she has to return the shares. So the whole idea is that when she returns them, the price will be lower than when she sold them up here. So she benefits from the stock price going down. And there's also sometimes people charge you interest for lending you the shares, like some stuff like that. Obviously, it's outside the scope of this question, but that's basically how it works. In this case, she would need to contribute the extra amount as margin because like this short sale amount is not part of the collateral. You got to contribute extra. The current price of a stock is $25 per share. You have 10,000 to invest, and you borrow an additional 10,000 from your broker and invest 20 grand into the stock. If the maintenance margin is 30%, at what price will a margin call first occur? So a margin call price uses the following formula. So we have the price of the stock now, and then we multiply by 1 minus your initial margin or your initial leverage over 1 minus the maintenance margin. So there's two components to it, right? One is your initial leverage, and then second is the margin that the broker sets. So in this case, we have a stock price of 25. The initial margin, well, you invest 10 grand of your own money and borrow another 10, so it's 0.5. So 1 minus 0.5 up top here is just 0.5. And then the maintenance margin is 30%, so 1 minus 0.3 is 0.7. And if you multiply this out, you get a value of 17.86, around that. And that's our answer B. Consider the following limit order book for a stock. So limit orders, are when people are trying to buy and sell a stock and they set a price at which their order can execute. And that's opposed to just using like a market order, which would, just use basically the market price currently. It might not guarantee you best execution, whereas if you set the limit price, it's not going to execute unless your order hits that price or better actually. And so we have bid size, and we have offer size, but offer is also known as ask. So the bid and the ask. Bid is where you're buying, ask is where you're selling. So we have limit prices, going from 122 to 124. So here's the cutoff. Let's clear this up. The cutoff for the bid ask spread is right here. So you can see we have bid orders here and ask orders here. So this is the highest bid spread, or the highest price at which investors are currently willing to buy. And then here is the lowest price at which investors are currently willing to sell. So there's a little bit of a spread here. So that's known as a bid ask spread. Anyway, we have a new buy limit order. So it's important that it's a buy order. So buy order placed for 300 shares at 123.40. Okay. So that is actually, so if we're just looking at this, 123.40 would be in between these two, right? So it would be the new highest bid price. So now this is an aggressive price, right? Because no one else in the market right now is willing to buy at this high of a price. So the limit order is said to, well, it makes a new market, right? So this is the terminology used for an aggressively priced security, because like I said, it's the highest current price that investors are willing to buy, so it's going to get priority over all of these, right? Let's go over the other two options just to clear it up. We could say in this case, a buy order takes the market if the order was placed at a price greater than or equal to the lowest sell price. So like if the buy order was, 123.90, it would just take the market. It just, takes the prices that sellers are willing to sell at and doesn't worry about this spread here. So it takes the market. It could even be at like, like 124.40, doesn't matter. They're just taking the market here. So this isn't the answer. For make the market, this is when a buy order is placed at the best bid price, or if a sell order is placed at the best ask price. So it would be making the market concerns these extreme values, while making a new market is in between. You have placed a sell market on open order. So we're selling for the time we're selling at market open, and the price that we're selling at is the market price. We're not setting a limit price here. So it's just taking the price in the market. So a market order that would automatically be submitted at the market's open tomorrow and would fill at the market price. So that's, yeah, exactly what I just said. Your instruction to sell the shares at market open is a execution instruction, validity instruction, or clearing instruction. So execution instructions, we can do for A over here. Execution instructions are related to price. So this is where, you can have your market or limit orders that we already talked about. And then for B, validity instruction is it defines when, so when the order can be filled. So you can have, in this case, our instruction to sell at market open is the validity instruction. So it's saying we want to sell it at market open. So you could also do like, good for the day. You can have your trade open for the day, but then if it doesn't execute during the day, then it gets canceled. You can have like good for day, at close. You can have a bunch of stuff. But validity, like I said, is just concerned about when. And for C, the clearing instructions, these are just related to settlement. For me and you and retail traders, the clearing instructions are all behind the scenes, and the brokerage and exchanges deal with that. And it's just, essentially a way to actually officially transfer the shares from whoever you're buying from to you. For us, like I said, it's behind the scenes. For some large hedge funds or institutional investors, they might be more involved in this, but like I said, yeah, for the retail guys, we don't even see this happen. Here we own shares of a company that are trading at 30 bucks currently. Your technical analysis of the shares indicates a support level of 27.50. Support. So it's basically explaining a support level here. So if the price of the shares is going down, it is more likely to stay above this level rather than fall below it. So like if the share price comes down to 27.50, then it's probably going to bounce back up according to our analysis. But if it falls below 27.50, it's going to keep tanking. So this is a level, and if it breaks this level, then it's going to keep tanking. Whereas if it hits like 27.51, then it's probably going to bounce back up. At least that's our hypothesis. So you have no immediate intent to sell the shares, but are concerned about the possibility of a huge loss if the share price declines below the support level. Which of the following types of orders could you place to most appropriately address your concern? Okay. A, short sell? No, we don't. The short sell would just be if we think the price is going to tank completely, but we said we have a support level here, and if it goes, you know, to 27.51, 28, it's probably going to stay above that level. But if it, like I said, if it goes below this, then it's going to tank. So what we would do, we have two good till canceled orders, which fits because we have no immediate intent to sell. So the order is going to remain open until we actually cancel it. So this is good. But then we're concerned about losses if the share price tanks. So we're going to have a stop sell order. So good till canceled, stop sell order, right? Because basically what this says is we won't have, this is different than a limit price, right? Because if we set a limit sell right now at 27.50 and the stock price is currently 30, then our order is going to execute immediately, right? Because we're selling at 27.50 right now, but the share price is 30. So, you're gonna it's gonna execute. Someone's gonna buy it, and it won't execute at the 27.50. It'll execute at probably like, I don't know, maybe 29.98 or something, because the basically our order is behind the market, right? We want to sell at 27.50, but people are already willing to buy at like 29 something. So we'll meet somewhere in between. You might actually get the full 30, it depends on the bid-ask spread, but if you do a limit sell, it's going to sell right away for sure. Versus the stop sell, basically it sets a price right now. So if the price, so stop sell, If the price hits our support level of 27.50, then we issue the sell at this price or the best price we can get at this point. So if it keeps tanking, then we might sell at like 27, depending on how volatile the market is. But that's the difference, right? So if in the stop sell, if the price doesn't go down here, then we're never going to sell. We're just going to keep holding, and maybe it hits like 28 and we still didn't sell, and then it bounces all the way back up to like 40 or something. So that's the difference between the stop sell and the limit sell. And last couple questions here. In an underwritten offering, so we've talked about this a couple times, right, in the corporate finance module. So in an underwritten offering, the risk that the entire issue may not be sold to the public at the stipulated offering price is borne by the investment bank in an IPO. So they're basically guaranteeing the sale of all the shares at a certain price, and if the market doesn't buy it, then they buy it. So it provides them some assurance to the company that's going public. Moving on, a British company listed on whatever exchange announced the sale of almost 6.7 million shares to a small group of qualified investors at 2.5 cents per share. Which of the following best describes this sale? Is it a shelf registration, private placement, IPO? Well, it's not an IPO because they're already, yeah, I guess this is an exchange. It's already public, right? It is a private placement because they are selling to a private group of investors, even though they're already public. And then moving on, a German publicly traded company to raise new capital gave its existing shareholders the opportunity to subscribe for new shares. The existing shareholders could purchase 2 new shares at a subscription price of $4.58 per share for every 15 shares held. This is an example of A. It's not an IPO, right, because they're already public, so it's an easy one. This is actually an example of a rights offering where shares are sold to existing shareholders. So you can see the difference here in the rights offering versus the private placement, right, where it's sold to a group of qualified investors who aren't necessarily the shareholders. And a key feature of the rights offering is that these shareholders can buy this new capital in proportion to their holdings. So in order to not get diluted, investors are going to have to buy exactly what this company said. So 2 new shares for every 15 shares held. So if I own 15 shares already, then I'm going to buy 2. I'll have 17 shares. And assuming everyone else buys shares in the same proportion, I'm still going to have the same equity ownership in the company. Whereas if I didn't buy it, then I'm going to get diluted a little bit because more people are going to buy the new shares, and I'm just going to keep existing my existing shares, which don't account for the new capital that was raised.